Meet Chase. Chase is a 24-year-old entrepreneur who sells a course on how to sell a course about drop shipping supplements he's never seen. Chase leases a Lamborghini Urus, wears a Rolex Daytona he bought at the absolute peak in 2022, and financed his Airbnb empire with variable rate debt. Chase looks rich. Chase posts Instagram stories with captions like, "We all have the same 24 hours." But Chase is technically insolvent, and he's not alone, because while the S&P 500 is flirting with all-time highs, the flex economy, the economy of hype, vibes, and buying things to impress people you hate, is quietly crashing. Watch prices are down 40% from the peak. Repo men are tracking G-Wagons like big game hunters. And the people who looked like geniuses in 2021 are finding out that buy now, pay later eventually gets to the pay later part. Welcome to the fake rich recession. Grab a drink. You're going to need it to watch this carnage. To understand why your Instagram feed is about to get a lot less flashy, we have to look at the party that started this mess. Go back to 2020 and 2021. The Federal Reserve was printing a money like they were trying to win an arcade game. Interest rates were effectively zero. It was an economic sugar high. Everyone felt rich. Why? Because of something economists call the wealth effect. When your crypto portfolio is up 400%, and your house ostensibly gained $100,000 in value while you slept, you start spending money you don't actually have. People weren't buying luxury goods because they loved craftsmanship. They were buying them because they thought they were investments. It's not a watch, bro. It's a store of value. We treated luxury handbags and Patek Philippe's like they were treasury bonds, but cooler. It was mass hysteria. It was the financial equivalent of chugging a Four Loko and convincing yourself you can fight a bouncer. You felt invincible. But here's the thing about being drunk on cheap credit. Eventually, the bar lights turn on. Then, the Fed took the punch bowl away. Rates skyrocketed. The free money era died. And suddenly, Chase has a problem. See, Chase bought that Rolex Daytona on the gray market for $45,000 because he was told it only goes up. He thought he could flip it next year for $55,000. Wrong. Today, that watch is trading for maybe $25,000. That's a $20,000 loss. But it gets worse. Chase didn't pay cash. Chase put it on a credit card or a personal loan. So now, he is paying 22% APR on an asset that is depreciating faster than a carton of milk left in the sun. This is what we call a margin call on lifestyle. The secondary market for luxury goods is currently flooded. Check the data. Inventory for luxury watches is sitting at all-time highs. Why? Because all the chases are trying to rush for the exit at the same time. It's a classic bank run. But instead of cash, it's people trying to liquidate Supreme hoodies and Richard Milles. Let's get into the mechanics of this, because the math is hilarious and terrifying. We are seeing the unwinding of the everything bubble. This rhymes perfectly with the Japanese asset bubble of the late 80s, where golf club memberships were trading like currency, or the tulip mania. We never learn. We just change the asset class. Let's look at the Section 179 crowd. You know these guys. The influencers telling you to buy a G-Wagon to write it off against your taxes. Here's the reality. A massive chunk of these luxury SUVs were bought with floating rate loans or high interest financing. Now, the value of the car has dropped to 30%. The loan balance is higher than the car's value. This is called negative equity. Chase is underwater, he's drowning in his G-Wagon. And the lenders? They are panicking. Subprime auto delinquency rates are hitting levels we haven't seen since the Great Financial Crisis. But it's not just cars and watches. It's the buy now, pay later bomb. People used Affirm and Klarna to buy designer clothes to look rich for a weekend in Miami. Now, they are defaulting on payment plans for pants they already wore. And stained with tequila. It is a cascade of insolvency dressed up as a lifestyle. Speaking of bad decisions, this is normally where I'd sell you a VPN. But honestly, if you bought a $300 t-shirt on credit, a VPN can't save you. So, what happens next? The fake rich are getting liquidated. The flex economy is dead. We are returning to financial purgatory, where assets actually have to justify their valuations. And cash is, well, not trash. The irony is that while Chase is getting his Urus repossessed, The boring investors, the ones buying index funds and wearing Casios, are doing fine. Warren Buffett famously said, "Only when the tide goes out do you discover who's been swimming naked." Well, the tide is out, and it turns out Instagram was a nudist colony the whole time. Don't be like Chase. Don't leverage your future to impress strangers on the internet, because when the repo man comes, he doesn't care how many likes you got. I'll see you in the unemployment line. Cheers.